AT&T recently reported their quarterly and full year 2024 results. The company reported in line with expectations for 2024. They added 1.7 million postpaid phone subscribers for the year in an industry that's not really growing, so that was a gain in market share. The company overall had a great year for what it had in front of it in terms of opportunity. But what's a fair price to pay for AT&T stock? That's the question I'm going to answer in this video by doing the discounted cash flow valuation on AT&T's business. Let's take a look. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. So AT&T is not expected to grow its free cash flow at all for the next few years. In my forecasted model, I took the numbers from Wall Street analysts that are following AT&T stock, and they forecast the company's free cash flow will decline from $17.3 billion in 2024 down to $16.7 billion in 2029. I highlighted at the beginning of the video that the company operates in a roughly zero growth industry for its smartphone wireless business. Everyone that wants a smartphone connection pretty much has one already in the markets that AT&T operates. So it's a matter of gaining market share in those new customers that are every year coming into the market, right? The younger generation growing up to want a smartphone, and that's being offset by some older folks that may cancel their smartphone, their wireless connection as they age and they don't feel like they need a wireless device anymore. So that's the market that AT&T finds itself in. Of course, the home high-speed internet area is still growing. They're still adding new customers in that segment, but the wireless segment is not going to grow. It's not expected to grow at all. So from the years 2029 to 2034, I'm forecasting that AT&T generates some level of free cash flow growth at 5%. And then from 2035 onward, another 2% revenue growth into perpetuity. So the company I'm forecasting between 2035 and infinity, that it grows slower than the economy overall and loses overall wallet share with consumers as consumers shift their spending to other categories, to other ways of staying connected. So when I take the present value of the free cash flows expected between 2024 and 2034, the value comes to $121 billion. If I take the present value of the terminal value, which collects all of the cash flows between 2035 and infinity, that's $174 billion. In total, the present value of the free cash flow that AT&T is expected to generate between 2024 and infinity is $296 billion. The weighted average cost of capital I used for AT&T is 7.85%. I gave them a cost of debt of 7.5% by taking the risk-free rate of 4.5% and adding 300 basis points to consider that AT&T bonds are riskier than government bonds, especially as AT&T has accumulated $146 billion in total debt. The company's beta stands at 0.73, and when I incorporate the beta into the capital asset pricing model, I get a CAPM cost of equity of 0.0888, in other words, 8.9%. The company has market cap of $163 billion and total debt of $146 billion. So I give them a target capital structure of 75% debt and 25% equity. AT&T's management team has said one of its priorities is to pay down this long-term debt balance. They want to reduce long-term debt now that interest rates are much higher. 10 years ago, in 2015, let's say, when interest rates were much lower and the company could borrow at maybe a fraction of the interest rates it can borrow today, it wasn't too concerned with the total debt balance. It was getting capital at very low interest rates, and so it didn't mind borrowing a lot of money. Now, interest rates are much higher compared to 2015, 16, 17, etc. And so now AT&T, with the higher cost of debt, no longer interested in adding to its total debt. It's actually more interested in reducing the total debt. And that has a bit of a positive virtuous cycle, because as AT&T pays down that long-term debt, its interest expense will decrease. That will leave even more free cash flow that it can use to pay down even more debt, which will reduce the interest expense further and leave even more cash flow. It can pay down more debt. And so it can continue to benefit from that positive virtuous cycle of paying down debt for a decade or more, given how much debt it actually has, $146 billion. So this trend can work in its favor if it can continue generating around 17, 18, $20 billion in free cash flow every year. It can allocate maybe a quarter of that, maybe a little less than that, to paying down debt every year and then lowering the interest expense and feeding on that cycle. To the value of operations, we need to add the company's cash balance and subtract the debt. That brings us to the value of equity of $152 billion. If we divide that by the number of shares outstanding, we get an intrinsic value per share for AT&T stock at $21.14. After the increase following the company's earnings release, the current market price is $24.57. So according to my intrinsic value calculation, it would suggest that AT&T stock is slightly overvalued. It's a little bit beyond the margin of safety I would apply in this case. So I would say AT&T stock is slightly overvalued. But that doesn't mean the stock price is going to come down, because the market can continue to disagree with me forever. I can have an intrinsic value per share below the market price or above the market price. The market doesn't have to agree with what I think. The market doesn't have to agree with my calculations. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.